expect what may happen and see how the market reacts, we need to talk about more regional banking pain. We need to talk about the jobs market and what surprising or shocking number came out this morning. And then, of course, we'll talk about housing, tax revenue, things of that nature. Let's get started. It is May 3rd, and this is your daily financial news. So, Fed Day. Let's talk about the least important or least surprising part and then get into what really could move the market and really cause some decisions going forward. First and foremost, the 25 basis point move that we've been calling for a long time will happen. I believe it is near certain that it will happen as expected. We'll take it from 5 to 5 1/4. Then things get interesting. We will have the prepared remarks or the press release. I expect it to be things like, higher for longer, inflation is still a problem. They'll probably talk about the banking crisis, and again, not their focus, but the banking system is strong. I mean, what else are they going to say? Then it'll be the Q&A. And what I am looking for first is, will Powell be perceived as dovish, meaning talk of pause, talk of let's see what the, how much of the backlog is coming through? Or will he say higher for longer, more is coming, our job's not done? We got some jobs numbers today, which we'll talk about. We got inflation numbers the last week, which really weren't all that great when you look at core. So again, I think the market wants Powell to be dovish, and I honestly can't fathom he will be anything but a hawk. I don't think he's Jackson Hole super hawkish like a pterodactyl, but I believe at the end of the day, when all the pundits talk, they will say Jerome Powell was more hawkish than expected. Then things get interesting. Because again, I still believe this Fed meeting, if they had to pick a day, they would not have picked May 3rd. They probably would have picked May 10th or May 17th. Because I believe the economic data that will ripple through in March will show the impact of what was Silicon Valley Bank, Signature Bank, now First Republic. I think it's getting dicier by the day, but we won't see that data for 2 weeks. So at the end of the day, I believe we close May 3rd with Powell and the Fed highlighting that more rates are coming. I don't think the market will like that. Then I think we're going to get economic data over the next 2.5 weeks that show just how off the rails the economy is. And then, of course, I think the Fed pauses. So again, at the end of the day, I think the market is going to look at this saying, okay, Powell's going higher. We've got 1 or 2 more coming. But by the middle of May, let's say the 20th of May, I think the odds of a pause will go up. So that's where I am thinking. We can't talk about the Fed without talking about regional banks. Regional banks are showing signs of stress, and they will continue to show signs of stress. Next up, we have Pacific Western Bank and Western Alliance. Kind of next in line. So we'll have to see where those go. Again, remember, folks, I've asked you to look at the S&L crisis, the savings and loan crisis from the 80s. Remember, the lesson that I'm trying to share from that experience is it was a long time, years, and lots of institutions. I believe I remember correctly that the savings and loan crisis saw 1,000. That's 1,000 institutions close or be absorbed by others. So don't expect this just to be over because First Republic Bank went to JP Morgan. There is going to be a long time of pain coming. I do think at the end of the day, we see consolidation with the strong getting stronger. It's kind of what this is going to be, but this is not going to be a moment. This is going to be with us all year, in my opinion. So it's not a moment. It's going to be with us for a while. So don't don't get too riled up about this, because if you get really riled up about one thing, you're going to get exhausted, because this is going to be with us for a while. Let's talk about the JOLTS report and the private payroll ADP report that came out this morning. First and foremost, the JOLTS report came in, I guess I'm going to say better than expected, lower than expected. I'll give you the numbers. Again, remember we were at 9.97 last month. We just broke the psychological 10 million level. Expectations were for 9.64. So what is that? 330,000 less job openings. It actually beat that by about 50,000. It came in at 9.59. So again, that number, which I believe came out on Tuesday, what is today, Wednesday? I think it came out Tuesday morning. The JOLTS report is heading in the right direction, but we still have let's round it to 6 million job openings. On the reverse side, so if that number came in better than expected, we got the ADP private payroll report this morning. And I'm going to call it a shocker. I'm going to call it not what the Fed wanted to see. Remember, one of the things that the Fed has clearly told us is they need to get slack in the jobs market. How do you get slack in the jobs market? Where you add less jobs. There's less job creation. Ultimately, you might actually have negative job creation. So what happened to ADP report this morning? Last was 142,000. Expectations were it would come in at 133,000. So the trend of coming in would be consistent and probably friendly for the Fed. Unfortunately, this feels really weird to say. Unfortunately, we had too much job creation. It's a weird market. Came in at 296,000. Folks, that is a beat by more than 100%. Expectations 133 came in at 296. Think about that. That is a massive beat. Where are the jobs? Leisure and hospitality up 154,000. Just leisure and hospitality beat expectations. Expectations were 133. Hospitality was up 154,000. Education, 69,000. And health services up 53,000. Where were the job losses? Well, we really had two. Financial services or financial sector down or negative 28,000. And construction went in at negative 38,000. Maybe a whisper of good news for the Fed, but I really don't think so. Last month's wage growth, according to ADP, was 7%. Came in this time at 6.7. Folks, this is the third level of inflation I've been talking about for a year. We've already seen goods inflation. Number two will be housing. Housing doesn't get meaningfully better until the summer, which is almost here, right? We're in May, July, August. Housing data, because of the way they calculate 12 months, you'll start seeing improvement. But wages, services, wages, 6.7%. On the wages front, I don't know if you heard this, but it looks like Hollywood writers are on strike. Yes, Hollywood writers have gone on strike. I guess it impacts the late shows and things of that nature. I don't watch a lot of TV, but apparently the Hollywood writers are on strike. They want more money. This is where we are. There's going to be a lot of this, and wages are going up. It's going to be sticky. I think that third level of inflation is going to be with us for quite a while. It's going to keep inflation higher than the Fed would like. So lots going on. Let's talk about home prices. Black Knight put out a report for March home prices, and they're up. These are national numbers, of course, national numbers. Home prices for the month of March were up 0.45%. So a 3-month trend of home prices up. Really, it's about active listings. You and I have talked about the housing market for the last year, and you and I have been right. The first thing was that housing transactions would crash 40%. We nailed that. Then we came in and said inventory's not showing up. In fact, I was featured in a Fortune article where we talked about this disappointment. So again, we have receipts. And what we are really suffering from right now, because the supply, in economics, there's a demand and supply. What people don't get, and we called early, is the supply has shifted. We're down 30%. Folks, this is the spring selling season. And we were right once again. The supply is meaningfully lower. So as rates move around, it doesn't take much of a demand change to move the market. On top of that, you add in below the median and above the median, and I don't think there's any question that below the median is on fire, almost as crazy as last March, and above the median is slowing down. And again, the above the median will continue to slow down as jumbo loans become harder. Folks, jumbo loans, something very few people are talking about. Jumbo loans are traditionally held on the balance sheets and typically done by regional banks. Does anybody think regional banks are going to be looking to extend jumbo loans in great numbers? Me neither. So according to Black Knight up, and again, inventory or new listings are down 30%. According to Black Knight, 92% of housing markets, the largest housing markets, were up for the month. Only 8% were down, which I thought was a wild number. Hollywood writers on strike, we talked about that. How about Gen Z? Shout out to Gen Z. According to an article I read yesterday, Gen Z, let me make sure I get this right. There we are. Gen Z, at their age, let's say 25, owns their home more than millennials and Gen X. So shout out to Gen Z and home ownership. About 30% of Gen Z, 30% of 25-year-olds own their home. Based on all the media cohorts that I see, I would have guessed it was less than 10%. But yes, according to, did I cite the source? I did not cite the source. I'll find the article and post it in the notes below. Gen Z owns 30% at 25 years old. Just for grins, millennials kicking butt too, 28%. So when millennials were 25, 28% of them owned their home. Gen X, my generation, not so good. We were only 25%. And I certainly did not own my own home at 25. So I was in the 63% camp that did not own. So yes, shout out Gen Z. Yeah, 30%. I would not have guessed that. Based on all the media reports about Gen Z and all of this, I would have been, if you would have asked me over under on 10%, I might have taken the under. And I would have been off by a mile. So shout out Gen Z. Oh, last article to talk about is California and New York. It's finally in. Their tax revenue, which again, they call it revenue, but it's our taxes. State taxes for New York and California. This number shocked me. In 2 years, 2020 and 2021, California and New York combined lost $90 billion. That's $90 billion of taxes. Folks, the movement to Florida, Texas, Tennessee, Nevada, state with a friendly state taxes are no joke. California is estimated to have a deficit of $28 billion and probably gets worse. It probably misses to the downside. So again, California and New York have some tough struggles we've talked about on this channel. What is likely going to happen? Unfortunately, as I shared a year or two ago, the middle class is going to be asked to pay more. In California, this number will be close. It won't be on because I read it a long time ago. The top 1% in California pays almost 50% of total taxes. 1% pays 50%. If you lose half or a third of the top 1%, where does the money come from? You either cut programs, which do you think California is cutting anything? You will raise taxes on the middle class. That's just how this works. So, unfortunately. Well, I do have some amazing news. Folks, if you've been waiting for the 4-hour Legends of Real Estate event, it just got loaded this morning. I will put a link below. Do me a favor, take a look at the thumbnail. My team created a thumbnail for this event. I want to ask you what you think of it. Leave comments below. It is $47. Don't worry, if you bought a ticket for the event, I will be working over the next 2 days to make sure you get access. If you bought the event, you do not need to buy it again. But a lot of you have asked for the recording. It is now live. I will put a link below. Again, I want to shout out Casey, Anna, April, and Alicia for giving their time. It was amazing. Just blew me away with the questions and interactions with the audience. So if you didn't buy the ticket, now you can go get it. Watch 4 hours of amazing legends in real estate sharing their story, experience, and answering your questions. Let's congratulate some people for doing the work. Probably the favorite part of my day. Let's start with Brad. Brad, congratulations. You got your golden ticket. Your card will go out in the mail. And Brad, you actually get 2 because you closed your first and your second deal. So congratulations. And then Jason, congratulations for closing your next deal. Gentlemen, your cards will be out in the mail. Folks, if you want to get one of these cards, all you have to do is close on your next or first transactions, do the work, only do great deals. We don't do bad deals. Then get me your address and you too can get one of these cards. Alrighty, folks, take care of yourself. Have an amazing day. It is the Fed day. Let's see what happens. Take care. Bye.